Welcome to the Cleantech Meetup. Today we are hearing from companies who have recently fundraised and are looking to scale. We are hearing stories about their experience. So our focus is on startups. Please welcome Janice Tran, CEO and co-founder of Canon Energy, and Kevin Wolf, president of Wind Harvest International. As always, our moderator is Gary Simon, chair and founder of CleanStart.
Yeah, this is just it's a look at how both companies have been doing in the march to being successful. And we thought there was some interesting new news with each. And let's start with Janice on Canon Energy. You're focused on converting waste heat into other usable forms of energy. What's the recent journey been like for you, and what progress have you been making?
Yeah, for sure. I'm probably not too far from many of the entrepreneurs that are on this call today. So like Thomas was saying, Canon was, or I guess I was a part of the CEO Start program a year ago. So it's kind of crazy to think that's been a year. And we started about a year ago, actually a year and a month ago. So a pretty new company. We started during the pandemic, so it's been completely virtual right now, which is, pretty interesting. But maybe it's because of the market timing. Is it maybe because we're all remote and we're able to kind of focus? I'm not sure, but it's been going really, really well, and we've been growing pretty quickly. So maybe just to back up, Canon Energy focuses on industrial decarbonization. The first kind of focus of ours is to look at waste heat recovery and waste heat to power. So we look at industrial sites, we look for waste heat that's emitted as part of the process, and then we turn that into clean, emission-free baseload power. And so that's been just hitting a heartstring on policymakers. We're getting more kind of robust on waste heat to power policy across the United States and Canada. We're getting lots of projects in our pipeline, and then we just got our first project in development a few months ago. So that's kicked off and ready to go, or at least starting on the development cycle. So anyways, we raised a round in right before Christmas of last year, and happy to talk through all of that kind of fun fundraising experience. Really quick, my background is in finance. I work at Generate Capital, which is a clean energy investment fund, for the last almost 5 years prior to starting Canon. So yeah, happy to talk through all the financing tips and tricks that I learned through Canon, and then also as an investor.
Well, I think that's a good place to start. What was that experience like? What did you learn, and was it very different being on that side of the table rather than the investment side?
Yeah, so I'm a first-time entrepreneur, and so that's been fun. So this is my first corporate raise. At Generate Capital, we were doing project finance, so slightly different. I did do a corporate deal, but still slightly different. It was definitely interesting. It was a little bit challenging because of the environment that we were in, because everyone was in lockdown. The beginning of the markets were still a little bit unstable, and climate tech was starting to get hot, but isn't as hot as it was right now. So we launched which is kind of crazy to think, that was just 8 months ago when we kicked off our fundraise. So it's kind of a different environment, but overall it went really well. There's some kind of tips and tricks that I learned. We approached 100 different investors of all kinds, angels, institutional capital, family offices, venture capital, lots of a variety. And we ended up settling on a group of 10 investors. And it was a mix of angels, some institutional capital through a family office, and a fund. So so it was a really good mix. I'll just pause there. We raised $1 million.
Okay, so one of the things in the class was a compelling value proposition. So as you worked through that in making your pitches, what did you come down to as a compelling value proposition for people?
Yeah, I think the value proposition is going to be different for every company. Our value proposition was really cracking the nut on industrial decarbonization. And so our unique view is that we are a developer, we're not a tech company. So we're not trying to create new IP. In fact, we have no technical IP, which is kind of a shocker to many investors and people. But we think that the gap in the marketplace is really good development and capital. So our company brings third-party capital and also does end-to-end development of these types of projects. So the value proposition was, you're linking up with a team of experienced developers and people who are well connected in the capital community that can finance these projects. That was a value proposition for investors. The value proposition to our customers is that a lot of these industrial facilities that are looking for an ESG story and also to start on their journey for decarbonization are looking for quick wins. And so that's what we offer, and they don't have to pay for it. In fact, we pay them for the waste heat. So, the steel plant is able to start decarbonizing and creating clean power, and they are revenue positive from day one because we're going to buy their heat, we're going to sell them back clean power that's cheaper than their bill, and they get to have the press release about it. So it's kind of a win-win on all sides. So that's a value proposition to your customer.
So I know you're not developing new technology, and you had several under consideration for utilization of the waste heat. Have you settled on a main course now in terms of what technology you're putting in your projects and offering to your customers?
We have a suite of technologies, and that'll always change. So we don't want to stick with one technology. We're technology agnostic. So it's pretty important for us to keep our eyes open and really understand where the technology landscape evolves so that we can provide the best fit for our customers. And it goes beyond waste heat. We also look at carbon capture and hydrogen and energy storage and microgrids and things like that too. Just we're not as focused on that today.
Well, it sounds like in your journey, you're at the point where if you had to do it over again, you would. You sound still pretty enthusiastic. That's great. You've had some early successes, so that's a reinforcement that you're on the right path. So congratulations with what you've been doing over the last 9 months to 12 months. So let's put Kevin on the spot now. So Kevin, you made a presentation on your technology, which is a vertical axis wind turbine with a lot of technology and math and modeling that really does make it a new type of device. Been many vertical axis wind turbines, but yours seems to have cracked the nut on how to make it economic. And your idea of essentially using the space in existing wind farms between the big turbine towers in order to harvest more energy was a good one. So when we talked to you last, you had just launched a crowdfunding campaign to build the first prototype, and you were successful at that. So what's been happening over the last few months since we last had you on the program here talking about wind harvest?
Well, a big thing was the SEC's rules on crowdfunding changed and were enacted March 31st. And the rules allow for not $1 million raised in a year, but $5 million. And we were doing a crowdfunding and a 506c campaign, an accredited investor campaign. So we could raise the $1 million from crowdfunding and then $2 million from accredited investors. And my gosh, it started right after January. It started really picking up in terms of the number of investors that were coming in. And when we found out the new rules, we closed our campaign so that we could save shares that we had allocated for this and do a second campaign in the summer, where instead of giving, equivalent of 6 shares per dollar invested, they would get 2. So now all of a sudden we could take the amount of shares that our stockholders and board had allocated and get roughly 3 times the amount of capital raised. So that was quite an exciting opportunity to realize, oh, clearly the public's very interested in this capital raise. And rather than raising it all at this more expensive amount that we originally thought it'd be difficult to raise the money, we've cut it down. So that's, we're preparing for another capital raise come in August. So it's everything from, well, we should probably think about our brand, and we should probably get more site control on more projects, and we, should hire some more people, and we should, really create a company now that we've got this chunk of money, and then go back into this second round with a clear vision of how we take that $5 million and roll the company out over the next 12 to 24 months. So that's where we are now.
Where are you in building the first machine?
Well, it's on its way to the UL facility in Texas. This international port problem, because we imported the permanent magnet generator from China and the turbine manufactured in Denmark. We are delayed almost a month because of the congestion in the international ports. It's one of the reasons why the next turbine is going to be made here in the United States. And so that is that, but it's all on schedule after that delay to be installed at the Underwriter Laboratories Advanced Wind Testing facility in Texas. And we expect to be able to show live 24/7 feed in July of the turbine operating.
Well, that'll be exciting to see.
Yes. It helps, you think about it. These people invested this money without seeing an operating turbine. Well, shoot, if they can see an operating turbine, they might invest again. Might be easier.
Well, it's that collision between the vision and reality, and sometimes it doesn't do what you think it will, but sounds like you're on a good path. So how many shareholders do you think you'll wind up with out of the process that you employed?
It's such an interesting process. We had 1,400 investors through the crowdfunding platform WeFunder. And the average investment was about $1,000. And about a third of the investment came from accredited investors. Mm-hmm. And about 25% of the investment came through lead investors, because we used your guys' idea for a lead investor agreement. And then that attracted people to help us bring in accredited investors into the program as well. But we're expecting the next round to roughly be the same. But it's an interesting possibility of having all these investors, but they're not on our books. There's only one addition to our cap table in this round, and that's the Wind Harvest Pilot Project. So only having one addition on your cap table makes it a whole lot easier to manage 1,400 investors. Those are all managed by the crowdfunding platform. The dividends that they get paid annually, the interest payments, all that stuff is handled by the crowdfunding platform. So we have no administration associated with that. So I'm expecting that we'll get, another 4,000 or 5,000 investors.
Kevin, something happened to your mic.
Something happened to my mic?
Oh, there we go. Now you're back.
Okay. So we get 4,000 to 5,000 new investors, but they become, evangelists for the company. We're going to try to help them crowdsource near-ground wind resources so they can help us find places around the world that have excellent near-ground wind. And so it's going to be an interesting opportunity to use those investor base to help build out the company as well.
Well, a lot of people are very scared by getting thousands of shareholders out of a crowdfunding campaign, but it looks like you found a way to not make that such a management hassle. Do you still have a lot of people among the shareholders calling up and saying, what's going on, or are you?
We send out an update every couple of weeks. That solves the problem, and then they love the fact that there's an update, and we send it right through the WeFunder platform. So it doesn't. We just post it there, and it goes out to the 1,400 investors. So that's a positive. One of the things that this crowdfunding.
Oh, we lost you again, Kevin.
Happened again.
Man, now back? No,
you're back.
Okay, I can't touch it at all. One of the things that the crowdfunding campaign allows is to have these accredited investors come through the campaign the company directly and not through the platform, which is nice, because then you don't pay any commission on it for those folks. The other thing it allows is for an SPV, a special purpose vehicle, to be created so that all the small investors go into that SPV, and that SPV only appears on your cap table in one place. So you only have one. We kind of invented that because the rule wasn't allowed. So that's how we did it. But now it's actually legally allowed, and it's set up, and it's much easier to do than what we had to do.
So the dividends and everything that are paid out, or interest, whatever, it's all just part of the special purpose vehicle. So it all depends on what asset is inside the SPV.
Yes. And what our trick was, we gave that SPV warrants for shares.
Okay.
For the money that they lent us. So they raise the money, they loan the money to us, and then we pay annual interest payments in January to them, and we give them warrants for the shares for each time they lend us money. And then those shares, when there's an opportunity to sell those shares, the special purpose vehicle sells the shares, and pro rata divides out the proceeds from the shares to all of the note holders. So it was an interesting combination. We had people who were like note holders, but did not like the risk involved in it. And then we had people who like equity, but didn't like the fact that it wasn't direct equity in the company. But enough people saw the benefits of the two things married together, equity and notes, that it clearly was supported.
So who'd you have as an advisor or a legal team that was helping you through this? I mean, you're brilliant enough, you could have thought of it yourself, but you probably had help.
No, we got the first crowdfunding company we went to said no, they weren't going to do this. So then we had to go find another crowdfunding company that would do that. Then we had to bring in attorneys to help us do that. So it was definitely a pioneering thing. And then you find out the next year, oh my God, they made it so it's part of the SEC's rules. So it makes it much easier than what we had to do a year ago.
Sometimes it's good to be the first mover. Sometimes it's good to be the second mover. Yeah. Well, I'm just curious, Brian Hoblet. I mean, this is a pretty positive experience that Kevin is talking about here. And yeah, I don't know whether at CVF you've looked at structures like this, or had heard a story as positive as this, but do you have a reaction in terms of what Kevin's been able to do?
Thanks, Gary. For people who are able to raise money any way they can, I would say go for it. We're precluded from making that type of investment. We have to make an investment in an active company, so it's a direct investment. But using the SPV, and Kevin's been successful at that, so congratulations.
Yeah,
absolutely. So you've been talking about sites, and I know you've looked at some of the SMUD wind farms in the Delta as potential prospects. Any progress there in having some sites in projects in the near term?
Yes. And one of the things I wanted to mention to Janice is she's got a better plan than we do in some ways, because she's not using new technology. She can get financing for it. The problems that we have with new technology is that banks won't finance projects with new technology. So we have to figure out how to raise the capital for the new projects when they can't be through loans. Mm-hmm. So the main way we're doing that is through hybrid wind, solar, storage projects, where the solar and the wind and the solar and the batteries are bank financeable, renewable energy credits, all that stuff. And then our part of the project, which is a smaller part of the project, comes in with a smaller amount of equity, but we own the entire project. So mm-hmm. it's a way around this problem of how do you finance new technology.
I have a question for Janice, kind of around this, a similar thing. So a lot of the startups, when they have their defendable IP, investors are looking for that outsized return, and that promise them the moon. And it seems like you kind of went after different investors, and that your kind of return is very controlled, and that you're basically promising them that you're going to execute on a project. I guess with knowledge and expertise, correct me if I'm wrong, but kind of what was that like? What did you have to emphasize to convince investors that you're going to hit your targets for a return?
Yeah, I could talk about this for hours. So I think that the current climate tech funding ecosystem is broken. There's a lot of, if you look at clean tech 1.0, a lot of venture investors lost money. And so we want to make sure, or us in the climate community should try to make sure, especially those that are familiar with finance, try not to do that again. But it's looking like it is just trending that way. There's a lot of venture capitalists that come in thinking that they're investing in software, and that don't understand like project finance, which, you know, when you're investing in climate tech, it's unless it's software, like it's going to be new technologies if that's what you're doing, and it's going to be like infrastructure, because we're not working in a digital world. We're working in the physical world where you have to build things, you have to decarbonize things, and it's heavy regulatory processes, and there's just a lot of capital involved with risks. And so the type of capital that comes in needs to understand how to navigate project finance, but also what are realistic returns and margins. So I spoke to a lot of investors, and my first comment was usually, we're not a typical venture-backed company, and we don't follow the growth trajectory that you would expect from a software company. And so we got, probably 50% of the investors said, cool, that's not what we do. We can't invest in you. We love your team, love what you're doing, great market, great problem. We can't do it. And even though many wanted to, they were just like structurally bound by their LPs that they couldn't invest in this. So then that got into a smaller kind of subset of investors. And the ones we thought, or that ended up kind of investing and really striking an interest, were those that had background in structured finance, or had a background in infrastructure, or came from family offices where their money was more flexible. But that being said, when you look at the margins of our business and you look at the trajectory of growth, like Sunrun is a multi-billion-dollar company that uses a very similar model as a developer. It doesn't have IP, but they're publicly traded. They are doing great. So that doesn't mean that non-IP companies can't be very, very successful. In fact, like, our margins are fantastic. But there is this like sense that you have to invest in like new tech, or that you have to, stuff a software model into the climate community, and it's not going to work. Yeah. So anyways, I think very few investors actually understand that I saw.
That's a very unique approach. I love what you're doing there.
And Kevin, I don't know if that you're finding that that investors that then understand your tech, they say, oh, okay, that tech risk is too high. I only take software risk.
Oh my gosh, yes.
Yeah.
You tell people, well, the wind industry, they're pulling 10% margins on the sale of their turbines, and they look at you aghast. How can anybody survive on a 10% margin? And we say, well, our average sale to wind farm is going to be probably $100 million. So you're talking about just a completely different scale. This is not a retail business.
Right.
And so that's just the way margins go when you're at that level of a sale of product.
Right. Yeah. I mean, a project to us is like $1 million to $2 million in revenue, and that's more or less just our margin. Like, there's no real, it's just time. And $1 million to $2 million, that gives us 2 years, 3 years of runway. So that's like, we're a very lean company that getting one project builds out our company for a while. But each project is going to be hard to, like, it's not, you're not selling hundreds of these, you're selling one or two a year, but they're big projects.
Right. Yeah, you and I are a similar boat. It's really about getting access to capital for projects. We're hoping that those new tax credits come in, and I'm really hoping that it doesn't go through, that it gives you direct income and doesn't go through the tax harvesters. So one of the proposals out of the Democratic Party is that the project developer goes in there and gets it directly. So if it's a 20% tax credit and it's a $10 million project, they get a $2 million check right from the government, right off the bat. So that would be the kind of thing that would really spur a lot of projects on. And So what we're looking at is, it's not really a vertically integrated company, but we have sales, but customers are not going to even line up until they've seen 50 of our turbines operating for 2 years. So we're kind of forced into the project development arena, which
Right.
we've got now talent, and there's just a lot of potential money out there, and there's all this leverage that you can do, and all of a sudden you can make more money off the project development side than you can on the margin on the sale of the turbine. So it's quite an interesting opportunity to go, well, I got this stupid big problem of new tech and the inability for banks to finance it, but it does lead to this opportunity for us to be a project development company as well as a technology company.
So Kevin, can I ask a question? In terms of your turbines, what's the levelized cost of electricity that you're producing?
Depends on multiple factors. We talked about the wind speed. So let's say it's the wind speed in the San Gorgonio Pass near Palm Springs, which is somewhere around 17 miles per hour at 20 meters above the ground, 60 feet above the ground. And we go into existing wind farms. So we do not have to put in a transmission line. We do a capacity factor enhancement project. We add 25% capacity to an existing wind farm. Make use of their existing substations and their existing roads and their existing property, and pay a percentage to the landowner and the company for the use of their land. We're going to be somewhere around, not including tax credits, so we can take the tax credit out of the levelized cost of energy. We're around 5 cents a kilowatt hour.
Okay,
now
that's
you add
competitive
tax
then.
credit in it, and all the other crazy stuff that goes into a levelized cost of energy analysis. For one more example, our turbines last 40 years. 40 to 60 years. We have aircraft aluminum blades and galvanized steel. That stuff just goes forever. But there is no monetization of a project over 20 years. So how do you monetize a project that lasts for more than 20 years? It's a difficult thing.
Could you get a PPA agreement and then take that to a
20
bank?
years is about the maximum PPA you'll get.
Okay.
Can you sell under existing PPAs for like the owner of the property in the San Gorgonio Pass?
Those existing PPAs are too high a price, and the utilities will not allow anybody to come in
that's
there
true.
and
No
tap into
enhancements.
the old PPAs.
And you were talking about hiring people, and of course, that's always been an issue in a growing company. How you find the right people, how you incentivize the right people. How's that growing for you, Kevin?
So we're looking for an engineer, and we for long term for the company, and we have they need to be able to do basic mechanical engineering, structural engineering, and we need them to also do our help with the CAD drawings for the next version of our turbine. So we're going to give the candidates a test. The top 3 candidates, we're going to pay them to work with our engineers to see how well they work with them and how well they produce the drawings. So it's like, okay, how do you know? Because you hire somebody long-term and you really don't know how they get along and how they communicate and all the rest of the stuff. So we'll pay them to take this test and produce the drawings for us.
How about other parts of the leadership team?
Well, we got lucky and found a guy here locally, just by luck, who's a patent engineer, a project engineer, a corporate attorney, lots of 40 years of experience in project development for energy companies. So it's like an excellent person to add to our team. So that was just luck.
Well, sometimes it happens. Yeah. Peter Mackin, you had a question.
Yeah, I did, but I think Kevin actually answered my question before I asked it. My question was, do you increase the capacity of the wind farms that you're connecting to? And it sounds like no, you're just increasing their load factor, basically.
Well, capacity factor. So let's say the average wind farm in California has a 30% capacity factor or 35%.
Right, but I'm saying capacity. So like if it's a 200 megawatt peak,
yeah,
you don't go over the 200.
Yeah, because then you have to add a transmission line and a new substation. And
not necessarily. Not necessarily. There could be capacity remaining in the substation.
Oh, very good. Yes. In those cases, right.
But the downside to that is that then you still have to file an interconnection request with the utility, and that's a 2-year process. So
yes.
Yeah. Okay. So I think that answers my question. Yeah. Thank you.
I've got a question for Kevin. So before on a lot of the pitches where you talked about how Wind Harvest was going to build, and it was going to be building the wind farms in the communities, and you had a strong kind of job connection on that as a way to kind of showcase that your technology can support also underserved communities. When you're going into this hiring process now with investment, are you guys taking any steps to kind of ensure that you have kind of, I guess, a diverse team so that you can go and approach communities like that? Or maybe this is a hard question for now, but yeah.
So one of the things why to get a diverse team takes a lot of looking. So we are in spreading our net as wide as we can. And we've told people that candidates, we're not even going to look at candidate resumes for a couple weeks to try to get that kind of diverse team in it. But it takes effort. And we're putting the effort in.
What's the team building been like for you, Janice?
Yeah, it's been really positive, actually. I've been learning a lot in that space. One of my very wise advisors told me, go into this thinking that it's probably about a 50-50 hit rate, that you'll hire someone no matter what you do. It's the best that you can hope for is the 50% success factor. So it's really about making sure that you have kind of mechanisms in place to ensure that they're a cultural fit and that they are, contributing to the team. And the type of person that you hire early on is going to be later than the type of person you hire like later on in your company. And so we've really focused on hiring people who are very entrepreneurial. We did like a pretty detailed exercise in the company to create our values. So that was pretty fun. And within that, we looked at what has worked and what hasn't, and then we went on proceeding hiring for those values. We did, make so far one hiring mistake, which we kind of knew pretty quickly wasn't a fit, and so we let him go within 3 days of him starting. And so we were pretty, actually, it was an interesting and kind of difficult decision at the time, but in hindsight, we ended up hiring someone who's just fantastic. So that was, one lesson learned. And the other, we had a co-founder switch off. So, definitely, ended in a very kind of amenable, agreeable way. He's an advisor now, but it was, as a CEO, really having to take a very diligent, purposeful view on the people who you have on the bus. And taking development of our culture very, very, very seriously.
Mm-hmm.
So yeah, so it's been interesting. I have a couple books actually to recommend. I'll post them in the chat here that have helped me kind of strengthen my views on hiring and culture.
How many people do you have working with you now?
I have 10.
How many people do you have working with you, Kevin? Oh, you're on mute.
Oh, yes. We have 5 engineers that are part-time spread across the world. We're bringing our first full-time engineer into the office, and we have probably another 3 full-time equivalent staff besides me. So it's still pretty small.
Yeah, but it's exciting. I mean, the growth is always sort of self-reinforcing in terms of bouncing out of bed in the morning, looking forward to the day. So you're an exciting time in the life cycle of your businesses, and I hope you keep it up.
Thanks.
Let me open to anybody else who has a question or a comment that they would like to make. Brandon, what do you think about this? This is really pretty good success for our little homegrown companies here, and some may want to come in and talk to Smud.
Absolutely. I know that we had discussions with Kevin a couple of years ago, and I'm glad to see them progressing through the steps that were necessary to start doing on the ground projects. And so it's an exciting opportunity, and I'm pleased to see them progress forward.
Yeah, it's been a good story, both of them. So Laura, you've got a lot of perspective in terms of the startups generally in the area. And I think, I don't know whether Kevin pitched it 1 million cups or not, but at any rate, what's your perspective from how they're doing here?
Startups in general?
Well, these two, yeah, and sort of how they fit with sort of what's the common story among a lot of startups in the Sacramento area. That
Well, first I have to apologize. I wasn't able to join till 6 because we had overlap with the Startup SAC event. So I missed their particular stories.
Oh,
I apologize
sorry.
for that.
Didn't mean to put
So-
you on the spot there. So anyone else want to ask a question or make a comment? It's pretty much an open conversation here.
Looks like Peter has a question.
Yeah, I have another
Oh,
question.
okay.
So, and this is for either Kevin or Janice, both. So are you looking for your sites mostly in California, or are you looking all over the US, just in the West, or where are you looking?
Janice, you want to go first?
Yeah, sure. So we operate in Canada and the United States, so it's everywhere. Our first project is in Ohio, and we're getting pulled to some other countries as well. So Australia is one that we're just recently started looking at.
Okay, great, thank you.
Yeah, we're about to launch a prospecting campaign with these interns. So what we have is a map, maps of the wind in the United States, and the Texas debacle with the freezing really helped hit home the importance of distributed wind. So because the wind farms are so, they want you to prove that you're not going to harm the tall turbines. So that's a couple years of LiDAR data. And then the projects are so big that they require financing. And then you got to deal with birds in most of wind farms. And all this takes years of study before you can unroll these very large projects in wind farms. But we realize, oh, there is this whole distributed wind market and energy market that's coming across the country because of the realization that, we should be producing the energy within the distributed grid. So across the Great Plains, there are almost every place has got good enough wind near the ground. So we're looking for project sites that are from data centers to meat packing facilities, et cetera, that have their project property size too small for the tall turbines. Because you have usually a setback easement of 1.5 times the height of the turbine. So if it's a 100-meter tall turbine, it's 150 meters away from their buildings and away from their property lines. And all of a sudden, very few properties are that big to handle the tall turbines. So they may have solar, but small property solar is expensive to put on your roof, and it takes up a lot of land as well. And these places like the Anheuser-Busch factory over there in Fairfield has 2 tall turbines on it, 2 megawatts plus solar, and they're still short a huge amount of energy that they could use, but their property isn't big enough to add any more renewables. So if you can go in there and find these project sites, so we're having the interns go through these data centers, go through the Underwriter Laboratory Wind Navigator site, and pull out the near ground wind speeds. And if it hits a power purchase agreement price plus a wind speed, then we go to the next step and start property, and then we make.
Okay, yeah, one place you might want to look if you haven't already is Cheyenne, Wyoming, because there's data centers there and there's lots of wind.
Oh yeah, there are all kinds of warehouses up there that are, we couldn't believe how windy it was right around the edge of the town where these warehouses are. So yes, it is a marked site that we're going to be exploring.
Okay, good. Because they need transmission too. So if you put the generators in there, that offloads the transmission, helps out the utility. So they'll be happy.
Well, this has just been a great update on what both of you are doing, and good news on both sides. We want to congratulate you and wish you the best for what you're doing. But this is a great one here that we can get back and talk with you on these sorts of things. Let me turn it back to Thomas. Are there other questions or anything else we need to consider at our meeting tonight?
I want to ask each of them what the moment that they thought they had something here, they had a company that could be fundable. At what point did you realize, I think I have a company that can be fundable here? And I'll let them end on that, and then we'll go to closing. So,
Janice?
Yeah. So you're able to get billion in projects in our pipeline, in our sales pipeline within the first 6 months of our company. So that was like, oh, okay, we've got something, and we were able to bring to investors that this is what's in our sales pipeline right now in various stages of conversation. And we were able to get conversations on three term sheets within the first few months of our company opening. So yeah, the traction was just, right away, pretty quick.
That's really quick, and
Yeah.
a great experience. Kevin?
Well, I always knew we'd have a market, or I wouldn't have stayed with the company as long. It was more of a question of how to raise the money without losing the company. And that was when realizing, oh, we can do this crowdfunding effort. And all my years of being an organizer and all the rest would come to play in that kind of a campaign. And then to see, as Christmas rolled around and seeing so much money starting to come in, and we had our first close and we could order the turbine, then it was like, oh, well, we've ordered the turbine. We've got the money for that. We finally can do it, because we've stuck for 4 years not being able to raise the money to order this next turbine.
Interesting. So Dan Kellen put a question in, and I'll let him ask himself, since he's been on due diligence teams. Dan?
Yeah, I'd like to get an input. I'm a angel investor and done a lot of due diligence, and I'd like to hear from your perspective. What are some things that investors made you do during due diligence and raise funding that you thought, or fundraising, that you thought was just a waste of time, or maybe it was a better way of approaching? And you don't have to be shy.
Well, I didn't go to accredited investors, and they didn't do due diligence. I mean, one of our $250,000 investors did due diligence, but more on the SEC filings than on the technology. In part because she knew me and trusted that I was not bullshitting her about the work, etc.
Any insights, Janice?
Yeah, I wouldn't say there's anything in due diligence that was painful or a waste of time. Maybe because I was an investor, and so it was colored by kind of the getting at the heart of what they were asking for was fine. So I will say though, I was very frustrated by the amount of kind of high profile investors that didn't understand project finance, but yet invested in companies that would inevitably rely on project finance to grow. So I just thought that was very strange, or companies or funds that invest in companies that rely on a developer ecosystem, but didn't understand what a developer was. And so when you look at like the growth of the solar and wind industry, Sunrun doesn't create solar panels, right? So, but they're able to be very successful. And they were able to do that by utilizing other technology that wasn't theirs. And so this model seemed very foreign to investors, and they just couldn't grasp funding a company in the clean energy world that wasn't creating tech and not understanding the developer role in growing energy ecosystems. So that I think I find like a little bit disturbing, but frustrating at the very least.
Yeah, and we figured that out a couple of years ago, that no, how can we convince somebody that we have customers if you're selling $5 million products and you don't have banks to finance them? So we realized we had to get into the project development business in order to show to the investors, hey, these are real projects. We really do have site control. We really do have, the ability to put a project on this site. And that was a key part of the due diligence process.
Which is, I think it's fundamentally flawed. Like, you guys should be focusing on building out your technology. So there should be an ecosystem that supports tech development and supports developers, not a hybrid of the two, because then you're just stretching your resources and building skills that you don't ought to be, you don't need to be building, right? So
yeah, but our problem was that there was no grant funding at all, nothing, no one would put a dime into an area like this. So we had to figure it out a way around that problem.
Yeah. I think that's a call to the investor community, is that understanding that the ecosystem is made up of different types of companies, not just a one-shot type of company. And yeah, the more that we can like fund the different aspects of the ecosystem, the better that the quicker that it can grow. So just funding tech companies and then funding development companies, and those are two different business models with two different types of investors and two different types of growth trajectories and teams. So yeah.
Oh, thank
Well,
you guys. Nope, sorry, go on, Dad.
I was just going to say, you know, part of due diligence. So from the investor point of view is also making sure that as an investor that investment or that company is the right one that will fit your profile or your portfolio. So that's, I think due diligence is really a two-way street. At least for me it is, because it's I'm not really focused on a particular technology, but really on a good business. And if it's a business in an area that I don't know a lot about, I'll learn about it, and maybe the company can help me learn about it. But if it's a great business, then that's something I want to support.
Yeah, I'll just jump in here. That this technology readiness level, the Valley group, that they were really helpful figuring out, oh, we need to tell people what technology readiness level we are, because startups are at technology readiness level 1, 2, 3. They don't have a full-scale prototype. That's technology readiness 6. It takes a long time and a lot of money to build a large-scale thing at a full scale. And then it's not your final product. You're going to have to go through the pilot project phase and then the certification phase, and you still have no revenue, and you can't even start sales. And so, yeah, they support startups, but do you even realize how to get a product from startup phase all the way through full commercialization? And I don't think people really understand that end part of the process and how difficult and expensive it is.
That's why I tell a lot of startups myself, having been through a company that ramped up production. So it's good that you're aware of that.
Yeah.
And
I think that's an interesting point that you bring, though, about how you fit into a portfolio. And I think that the venture style of investing is this, 10x, 80x type of return that they're looking on their invested capital, versus a more private equity style return, which is like a 3x more stable type of return, versus a project finance, which is like a 10 to 12% unlevered return. And so a balanced portfolio for a family office or for any type of institutional investors is or money manager will look at all different aspects of those types of returns. And so I think I would argue that there is a kind of a role for a clean tech, climate tech company in every aspect of the risk portfolio that you're looking at. It just requires more nuanced thinking of how the different aspects of the clean tech ecosystem works, and not just to kind of paint it with a brush.
Yeah, and I think that's probably true for maybe more professional investors, but for a lot of angel investors, it's something, maybe it's an exercise for them to learn more about technologies or just stay in the business. And they're not as interested in a diverse portfolio as a family office or a professional manager would.
all right, excellent discussion. I know that we could talk a whole lot more, especially when it comes to the value investors can provide to companies they invest in. But since Janice talked about having a network that supports companies, I won't figure this would be a great time to plug at least the resources in California. And now I want to thank and give a round of applause to Janice and Kevin for coming here and being subjected to our questions. Thank you very much.
Thanks, everyone. Thanks for having us.
Yes.
Yeah, great discussion. Thanks, and congratulations again.